Hi, everybody, and welcome back to video number 5 in Chapter 11. When we left off, we were looking at bargain purchases. In a few cases, a purchaser in a business combination will pay less than the fair value of the identifiable net assets. I would say it's very unusual, but nevertheless, such a situation is referred to as a bargain purchase. A bargain purchase results from a market imperfection. That is, the seller would have been better off to sell the assets individually than in total. In a bargain purchase situation, the excess amount is recorded as a gain by the purchaser. Okay, let's take a look at that. The creme crust is experiencing liquidity problems and has to sell its business. Creme crust's tangible and intangible assets have a fair value of $900,000 and liabilities of $100,000. It purchases the business for $500,000. How would you report the information on Meltone's financial statement? What entry would you make to record the purchase? So here, we're going to take a look at the tangible and intangible assets of $900,000 fair value, less the liabilities at fair value, gives me $800,000 net asset. Purchase price, $500,000. Gain on acquisition, $300,000. Not negative goodwill, right? Or goodwill. Okay, the journal entry for Meltone then is going to be the assets. We're going to record those all at fair value here. Liabilities we're going to record at fair value. Cash is going to be credited to pay for it. And then we will record a gain on the acquisition. And we're going to report that in the income statement in other revenues and gains section. So it is part of continuing operations. Okay. Goodwill disclosure. Here, Pfizer Incorporated has some notes to its consolidated financial statements. And here, note 1 tells the details associated with the reporting of its goodwill. And they define it here, the fact it's not amortized, and that they look at it for impairment. And then the identifiable intangible assets and goodwill, they break that out into its pieces. Okay. Let's take a look at putting this all into practice. On July 1, 2025, James Corporation purchased Devon Company by paying $300,000 cash and issuing a $50,000 note payable to Linda Devon. At July 1, 2025, the balance sheet of Devon Company was as follows. So here's their balance sheet. Now, the recorded amount for Devon Company all approximate current values except property, plant, and equipment here. And the fair value goes up by $20,000 to $205,000. Inventory goes up by $25,000. And trademarks goes up by $5,000. So, determine the amount of goodwill to be recorded by James upon acquisition of Devon. Then under Bravo, prepare the December 31 entry for James Corporation to record amortization expense. The trademark has an estimated useful life of 4 years with a salvage value of $3,000. Under Charlie, at the end of the first full year of operations, which is 2026, James conducts an impairment evaluation for the Devon reporting unit. The fair value of the Devon reporting unit is $300,000. The carrying value of the net assets, including goodwill, $335,000. We'll need to prepare the necessary journal entries given that information. Okay, let's look at alpha. First of all, we're going to update all the assets and liabilities to their fair values. And if I do that, I find that we're short $65,000. So we're going to record that as our overpayment here of $65,000. And how we get that is we take the $300,000 of asset of plus the $50,000 to get $350,000 here, right? And then the fair value of the identifiable assets, $285,000. How we get that is that we take $435,000 plus $20,000 property, plant, and equipment, $25,000 of inventory, $5,000 of trademarks minus the accounts payable. And that gives us our fair value. Pretty easy calculations here, right? The $300,000 was here in cash, and then the $50,000 note payable. That's where we get the $350,000. All right, that results in $65,000 of goodwill. They have a note here that the property, plant, and equipment would be recorded at the July 1, 2025. The cost to James, accumulated depreciation accounts would not be recorded as the new ones and will be started by James after the purchase. Okay, under Bravo, the amortization expense is going to be $1,500 for the trademarks, and we get that by taking the $15,000. Let's go back, get those numbers for everybody. Here is our trademarks of $10,000. The fair value was $15,000. And under Bravo, the trademark has a useful life of 4 years and a salvage value of $3,000. So what we're going to do then is relatively easy. We take the $15,000 minus the residual value at the end, that's $12,000. And we have 4 years, so that's going to be $3,000, but it's only for a half a year, so 1/2 of $3,000 is $1,500. There is no amortization of goodwill. We don't amortize goodwill. It can be impaired, but not amortized. So if we compute the possible impairment at the end of 2026, the fair value was $300,000. However, the carrying value, including goodwill, was $335,000. So now we have an impairment loss of $35,000. You'll notice that, yes, we have a debit to loss on impairment of $35,000, but the credit is a reduction of goodwill by $35,000. All right. Okay, now we're going to describe the accounting and presentation for research and development and similar costs. Here, research and development costs are not in themselves intangible assets, and I should say anymore. They used to be back several years ago. Frequently, this results in something that accompany patents or copyrights. That's why we do R&D. We want to develop a new product, process, idea, formula, compensation, or literary work. Now, companies must expense all research and development costs as incurred. All right. Companies spend considerable money on R&D. Here's Pfizer, Facebook, Motorola, 3M, Boeing, Kimberly-Clark, PepsiCo. These are big numbers and important to move those companies forward in the latest technologies. Pfizer, you may recall, where it had some of the vaccines for COVID-19. So here's the research and development activities, and we're trying to discover new drugs or medicines, in that case, looking for applications. Then once we do that, we look to improve our existing process or invent a new product. This conceptual formulation and design of possible product or process alternatives, construction of prototypes, and operation of pilot plants to get those research findings into practice. The costs associated with R&D include materials, equipment, and facilities, personnel, purchased intangibles, contract services, and indirect costs. So here are a number of different kinds of R&D expenditures. And if it's construction of a long-range research facility for use in doing R&D, we'll capitalize that and depreciate it as an R&D expense. But generally, the acquisition of R&D equipment for use on current project only, we're going to expense that. If it has more than one use, then we could capitalize that. And then that's what they say here, et cetera, et cetera. I will let you read those as you go through. I think this is good to really get a sense as to when you capitalize R&D expenditures and when you expense them. Generally, we're going to be expensing them, the development costs, immediately as R&D expenses. All right, so how would these items listed below be reported in the financial statement? Investment in a subsidiary company, long-term investments. Timberland, property, plant, and equipment. Cost of engineering activities required to advance the design of a product to the manufacturing stage, R&D expense. Lease prepayment, 6 months paid in advance, that's an easy one, prepaid rent. A lease prepayment 6 months in advance, cost of equipment obtained, PP&E. And lastly, the cost of searching for applications of new research findings, again, R&D expense. Cost incurred in the formation of a corporation, that's an expense. Operating losses incurred in the startup of a business, operating loss. Training costs incurred in the startup of a new operation, that's an expense. Purchase cost of a franchise, that's an intangible asset. Goodwill generated internally, we're going to not record that. And lastly, cost of testing in search of product alternatives, R&D expense. That looks like a good place for us to stop this video. And when we return, we'll continue to look at how we categorize R&D costs. Until that time, bye for now.